of Truth with your host, Rory Hall from thedailycoin.org and Dave Kranzler from investmentresearchdynamics.com. We have on the line Mr. James Turk from goldmoney.com.
I just wanted to say that I feel incredibly privileged to have Mr. Turk as a guest on our show here. I have always considered Mr. Turk one of the most profound thinkers in the gold investing community, and I've been following his work and his writing and exchanging emails with him for the better part of 14 years. Anytime I get a chance to listen or read what James Turk has to say and read his analysis, I always jump on it.
I think that's a very wise decision, and one in which I would agree with wholeheartedly. I don't miss anything that he writes, and I don't miss anything that he says. I haven't been in the market as long as you have, Dave, but it's truly an honor to have the precious metals expert, founder of goldmoney.com, and author of several books, including his latest, The Money Bubble, James Turk. I mean, it's incredible. I'm very grateful.
You. I'm well, over and above the general agitation I feel when I wake up every day and see how manipulated the markets are.
I know exactly what you mean. But I do sense that things are changing here, and rightly so. I mean, just even looking at it from a technical point of view, we've got what potentially could be a huge base in gold, and the metals keep trading at backwardation over here in London, so they're going to have to run out of physical metal pretty soon.
Now, how far in backwardation are they currently, James?
I haven't looked in the last few hours, but when I looked this morning, gold was about 50 cents backward and silver was about 2 cents backward, which is down a little bit. But with gold and silver coming back here again this afternoon, I would guess that's probably opened up a little bit. Okay. That's on the front month.
Just for the listeners' clarification, can you explain by what you mean by gold backwardation?
Yeah. Gold is normally in what's called contango. The spot price is less than the future price. The difference between the spot price and the future price is the cost of carry. In other words, the interest expense that it takes if you're going to be carrying gold. Gold is different in that sense than copper and corn and any other physical commodity like that, because those have very high carrying costs related to storage. But gold really doesn't have effectively any storage costs. So the difference between the spot price and the forward price is really just the interest rate and gold's relationship to the interest rates in other currencies. So gold is, always, for that matter, in contango. When it goes into backwardation, meaning the spot price is higher than a future price, and I was talking here about 1 month forward or 1 month in the future, that's an anomaly in the market. And it shouldn't happen in theory, because if you own physical gold, what you would do when it goes into backwardation is you sell the physical, buy it back in the future at a lower price, avoid the storage costs, and have the ability to take that money you receive from the sale and invest it for a month until you need it in 1 month's time, to buy back gold in the future. So the fact that you have backwardation happening is an anomaly in the market. It suggests that the demand for physical is extremely tight, and that there's more physical demand than there is, paper demand or demand for paper gold.
Speaking of demand, I wanted to ask you something, and if you'd rather not answer, I certainly understand and respect that. But I wanted to ask you about goldmoney.com and what you're experiencing right now in light of what you just said. Are you experiencing an upswing in more customers? Are your current customers, are they adding to their positions, or what's actually happening, if you don't mind sharing that? I'm not asking for details.
When you were asking me that question, I thought you were going to say, well, do we have any problems buying physical metal? When we go into the market and buy physical metal, because that's all we basically supply for our customers, and the demand has been good, we're buying at maybe $500,000 worth of metal, or $1 million worth of metal. We're not in the market, buying 10, 15, $20 million of metal. If you go in and try to buy a large amount of metal like that, that's where you're going to see the problems with backwardation. And the dealer would say, yeah, okay, or let's do it this way. You go in and ask for a quote, and the guy's going to give you a quote for what he believes to be, a paper transaction. And let's say you're buying $20 million. And then you tell the guy, well, look, this is something I want delivery. And then he starts saying, oh, okay, well, it's not going to be T+2. Or in other words, we're not going to deliver this in 2 days as we normally would. This price is good, but we're going to deliver to you in 3 weeks. For the simple reason that he has to scrape that metal together in order to make the delivery on a large transaction. So that's why you don't necessarily see a backwardation on a small transaction, but it's there definitely on the bigger transactions. But even the small transactions, you're seeing it. Sometimes coin premiums will rise considerably simply because physical metal is tight, as an indication. So whenever you see the future price of gold lower than the spot price, you know that there's an anomaly in the market. And I guess the most important thing that it's saying is that people who own physical metal are passing up the opportunity to arbitrage by selling the physical metal and buying it back at a cheaper price in the future, because they don't think the risk is worth it, or they think the risk is too high relative to the profit that they could be making by participating in the arbitrage. And that's usually a sign that you'll see when you're near the end of a life of a currency. In other words, confidence in the currency is shrinking when you see that kind of event. But you see this in other areas as well, because people are paying record prices for things that 5, 10 years ago would have looked pretty silly. And I'm talking here about collectible art and some of this stratospheric prices that have been paid for some of the works of art that are out there, or some of the real estate prices that we're seeing here in London, where I live. Or other things that people are going into tangible assets like collectible cars. Prices are really out in the stratosphere on a lot of these things, and it's basically saying that people would rather own things than own paper, or they don't want promises. They don't want to be. They don't want their wealth subject to counterparty risk.
Can't say that I blame them.
Yeah, in this environment, it seems like the logical thing to do. Yeah. And it's not just individuals that are doing it, but certain governments around the world are doing it as well. You see China spending its reserves, gobbling up resources wherever it can. And you see, a movement of gold again picking up over the last year or so out of the New York Federal Reserve, returning back to countries who own that gold. They want it for whatever reason. So it's an indication that there's a lot of fragility in the paper system, and that's to be expected, because when you have this much debt in a paper system, typically the paper currency ends up getting inflated away to nothing. It's not a way to preserve one's wealth or one's purchasing power.
And I was listening, James, to your interview with Greg Hunter over at USA Watchdog earlier this morning, and you guys had discussed Greece, and I want to kind of follow up on one of the things and with Greece having a long history of religious and cultural ties with Russia, would it make sense for Greece to begin working with Russia to help them get out of the euro and the EU? And if so, what would that look like in your opinion? And if not, why wouldn't it be to Greece's advantage to follow Iceland's lead and simply default?
Yeah, well, that's a really good question. It's one that I've been thinking about, and I'm sure a lot of people around the world have been thinking about. There are no doubt strong historical ties between Greece and Russia. There's no denying that. So, when Mr. Tsipras goes to meet Mr. Putin, one would expect that, that would be a friendly and cordial meeting. But there are a lot of complications to the scenario that you're leading toward or to the questions that you've asked, in the sense that Greece is a member of NATO. It's also a member of the European Union. You can compare it to Iceland in some respects because of the high indebtedness, but Iceland was not an EU member, nor did it use the euro as its currency. So we saw in Iceland, when the debts became unsustainable, that the currency collapsed, the economy collapsed, and Iceland moved forward, basically defaulting on all of that debt. What's happening in Greece now is because Greece owes so much money to other members of the Eurozone, and particularly the banks in the Eurozone. The ECB, the EU, with the help of the IMF, are bringing pressure to bear on Greece to effectively say, look, you've got a lot of debt, but we're not going to allow you to default. We're going to send more money to you in order to keep this game going, so that people think that you're eventually going to repay these debts that you have outstanding. But you can't compare the situation to Iceland, because Greece doesn't have its own currency anymore. It doesn't have the drachma, and if it defaults, there are real question marks about what's Greece's role in the Eurozone will be. Just like happened in Cyprus. Cyprus is in the EU, it's also in the Eurozone. It effectively was not allowed to default on its debts. And what happened was the ECB stepped in, took money out of the Cypriot banks, and used that money to repay the loans that the ECB had extended to Cyprus. And this is the so-called bail-in. And I think that's the formula that they're going to be following in Greece. And in the paper this morning here in London, there was an article saying that Greece is rapidly running out of cash, which is everybody knows. They didn't talk about what's going on in the banking system in Greece, but as I understand it, money is still fleeing the banking system because people recognize that their money is at substantial risk if they keep it in Greek banks. In other words, it's likely that the ECB will do a bail-in in Greece, just like the ECB did a bail-in in Cyprus, because the ECB is not going to take a loss on its credit exposure to Greece. If Greece can't repay the ECB, what are the ECB's alternatives? The only other alternative is they can go to the rest of the European community and say, look, Greece is not repaying its loan. We want to be repaid, so we're going to tax every member in the European community by the amount of the Greek loans in order to repay this debt. There are countries in the European Union that have lower personal incomes than on a per capita basis than Greece, and are seen to be less wealthy than Greece. And there are a lot of other countries in the European Union that have their own debt problems. So there's no way that's going to float. And there's no way it's going to float that the ECB is going to take a loss. So the only thing that I see happening, and it's probably going to happen soon, is a bail-in of Greece bank depositors by the ECB. They'll call it nationalization by the Greek government, but it's really going to be the ECB calling the strings from behind the scenes.
What would I don't want to really focus much on Greece now that, because we've got you on the line here, and I would love to pick your brain a bit on gold, but what's to stop Greece from just pulling out of the EU and reverting back to the drachma? Because that's an option I've always thought was viable for them.
Yeah, you're getting into a lot of legal issues as to whether they have the ability to renege on a treaty agreement that they've established with the other members. They over here in Europe, they call the European Union a club, and you become a member of the club. But, it's a club which is easy to get in, but it's not necessarily so easy to get out. So I would think that they would have a lot of legal issues. I mean, they could do things unilaterally, but, what is Greece going to fall back on if it were to do that? It would only fall back on the resources of its own people, and its government's ability to collect taxes from its own people, because it has very little other resources. Even the gold that Greece has, I don't think they have control of that gold anymore. I think that gold is in the control of the European Central Bank, and they're not about to give that back to Greece. So Greece has very few options, and whether they can get help from other parties like Russia or maybe China or who knows where. They have very few choices other than to um, plow ahead as best as they can. But the ultimate issue here is, this isn't just Greece, it's all countries that have too much debt. What are they going to do with that debt? The debt has to be repaid or it's going to be defaulted. So it's either paid by the borrower or it's in effect paid by the lender when the borrower defaults. You can't avoid that reality. And that's the thing that the global economy has been trying to come to grips with since 2008. We still haven't solved these debt problems. In fact, they've become worse since 2008 because the total quantity of debt in the world today is up substantially since from the levels that prevailed in 2008.
You know what I find most amusing about the whole debt conversation is everyone puts a microscope on Greece or Japan or China. At least in this country, that's where the microscope is focused. But the fact of the matter is, when you add up government debt plus private sector debt, the United States is by far the largest debtor in the world.
Yeah, absolutely. And then you throw in all of the contingent liabilities that the U.S. is, guaranteed, and the pension liabilities, the Social Security liabilities that the U.S. government doesn't properly account for, and it's truly staggering. So, I mean, at the end of the day, if you look at it and you try to comprehend how much it is, and then you try to apply a factor to it, like, is there enough wealth being created in the United States in order to service all of these debt obligations? You just have to shake your head and say, there's no way all of these debts are going to be repaid. So what you really want to do from your own personal portfolio point of view is mitigate, avoid, wherever possible, reliance on government promises. And this is true regardless whether you're living in the United States, living in Greece, living in Italy, or pretty much anywhere else in the world, because just about everywhere governments are very, very over-leveraged.
It's funny, James, because I think some of the academics that look at it now put those contingent liabilities together with the existing non-contingent liabilities, and they come up with about 200 trillion now. And I don't even look at that. If you just look at the 18 trillion in government debt, this country's not producing enough wealth to just service that. And how do we know? Because that debt amount is growing by at least $1 trillion a year every year now.
Yeah, you're absolutely right, Dave. And that's what it all comes down to at the end of the day. Because if you cannot service those debts aren't worth anything. So you can't really consider them to be wealth or any kind of deferred purchasing power, because they have essentially next to nothing in terms of value.
Well, not only can we not service it, we have to issue more debt just to do a partial servicing of the existing debt. I mean, it's just absurd.
Oh, I see your point. Yeah, and then if you add the interest effect onto that as well, the only reason why they've kept the game going as long as they have is because the U.S. government's interest rate on T-bills and the like is near zero. If they were paying a fair interest rate on the debt, so that savers would be compensated in a fair way to earn an interest rate over the annual rate of the cost increase in the cost of living, the U.S. government wouldn't be able to handle it. They'd have to borrow more money just to pay the interest, and that's how you end up going into a hyperinflationary currency collapse. And I still think that's ultimately the way it's going to go. Or the U.S. government says, we have all of these obligations, and it starts picking and choosing who gets paid and who doesn't get paid.
That actually brings up another interesting point. Again, not necessarily, it's related to gold, but at what point do you think the rest of the world, especially the ones who are financing most of, besides the Federal Reserve, the ones who are buying government securities that are issued on a bi-monthly basis, at what point do you think the rest of the world says no mas to it and just says, we're not buying any more of your debt until you start paying us back what we've already lent to you? Or do you think it's going on right now in subtle ways that aren't obvious?
Well, I think the fact that China is, using its accumulated reserves to buy tangible assets, huge amounts of physical gold flowing to China, China going to Africa and gobbling up resources wherever it can. I think that's already sort of a subtle indication that people are questioning, whether the U.S. government can ever repay its huge debts and are taking steps to protect themselves. But you're also asking here a very good geopolitical question that we have to ponder. The situation's gone on longer than I expected because I didn't think that people would be willing to play the game as much as they have, compared to what prevailed while the Soviet Union was still in existence. Back then you had the American nuclear umbrella. And people wanted to be within or be under that American nuclear umbrella, just in case some rogue premier of the Soviet Union started a fighting war somewhere in the world. To have that safety and security of being under the American nuclear umbrella meant a lot, and you're willing to put up with a lot in terms of American demands and American largesse in terms of spending money and accumulating huge deficits that they're never going to repay with the rest of the world. But when the Soviet Union collapsed back in 1990, whenever it was, then we're in a situation now where you don't really need to be under an American nuclear umbrella anymore. There isn't that global threat that there was back then. So I think you're going to be less willing and less congenial to meeting American demands to do things that the Americans want. And a good example of this is what's happened recently, just over the past week or so, with a Chinese-led venture or organization called the Asian Infrastructure Investment Bank, the AIIB. The American government had been lobbying governments around the world, people who are perceived to be, or countries that are perceived to be strong American allies, not to join the AIIB because it was under Chinese influence, and the government felt that if countries started joining the AIIB, American influence would be diminished. And they're actually totally correct in terms of that interpretation as to what would happen. But a few weeks ago, countries one by one thought to be strong allies of America and pretty much would do what America had been bidding them to do, started joining the AIIB. I think just about every European country is in there now. And most recently, Israel said that they're going to join the AIIB, and they're one of America's strongest allies anywhere in the world. So it's a sign that American influence is declining, and as American influence declines, the demand for the dollar is going to decline. And as the demand for the dollar declines, the debt problem in the United States is going to become greater. And of course, the gold price will go up in that environment.
I want to shift it over to gold, if you don't mind, James. With China beginning to set a global gold fix later this year, will this have an impact on the pricing mechanism in London and New York? And if so, how do you see that coming to fruition?
Yeah, I think it will have a huge impact on the pricing mechanism. I mean, it's already had a big impact, the Chinese involvement in the market. That's why we're trading in backwardation because of this huge demand for physical metal, which is flowing from west to east. It will probably lead to a more open and fair pricing process. But remember, money is power and gold is money. So whoever, can control the gold, gets a lot of power is associated from that. So I don't think we should be expecting that the Chinese government's going to go back to the old classical gold standard, because the old classical gold standard required limited government and free markets. And I just don't see the Chinese leadership moving toward limited government or free markets. We're at a stage where the international monetary system is going to change. It's going to have an impact, in my view, on geopolitics. It is already having an impact on geopolitics. And how that plays out, I don't know. But what I really do worry about is whether it's going to play out in a way where there are no real hostilities arising as a consequence of this change in the economic and geopolitical order of events and things. I would hope that there are going to be no hostilities, but gosh, sometimes people can get a little bit crazy, and funny things, tragic things happen. So
yes,
you have to be careful.
I want to ask one more question, then I'll turn it over to Dave, and then we'll probably. This is a question that I've been asking of a lot of people for about 2 years now, and where is the gold coming from?
Yeah. The fact that we've seen, I think London has been pretty much emptied out. I don't think there's a lot of physical metal left in London anymore that's available for shipment elsewhere. London has always historically been a big place for storing physical metal. I don't think there's a lot of metal left here. And the fact that we're starting to see metal coming out of the New York Federal Reserve, in my mind, is a clear indication that there's of the tightness that's occurring here in London. Some people have been saying that this metal is coming out of the United States and going back into vaults of the different countries. And this was used, for example, to explain why the Dutch received their gold back in return. Well, it could be that the Dutch are getting the gold back into Holland, but they in turn are relending it into the market in order to take care of some of these tight physical market conditions. And it's also sort of logical to look at it that way. Why did Holland get its gold and Germany did not? Well, Germany was quite clear that it was going to take its gold and put it into the Bundesbank vaults and not relend it into the market. Holland, it wasn't quite so clear. So, maybe that's why, Holland got its gold and Germany didn't get its gold. So, you can't make predictions about these things as to how events are going to unfold or the timing how they're going to unfold. But, it seems quite clear that there is a lot that we're getting down to the end where the available physical metal to keep putting it into the market and keep sending it to Asia is coming to an end. In that sense, it's different than the 1960s when the London gold pool collapsed in 1968. Back then governments were a little bit more transparent and a little bit more honest, and you could see the gold actually coming out of the vaults and where it was actually going to. Today, because of all of this gold lending and leasing and gold depositing that governments are doing, and because of the way central banks now defy generally accepted accounting principles when they have gold and gold loans on their balance sheets, you don't know what governments are doing anymore with regard to gold. So there's a lot of guesswork here. And in an environment like that, with all of that uncertainty, you just have to be prepared from the point of view that everything will come to a head at some point in time in the future. It might be tomorrow, it might be a year from now, it might be longer than that, it might be 5 years from now. But basically, you just have to prepare for it because eventually reality will return. Gold will go back into its normal contango, and it will trade at a fair price where governments won't be able to sit on the gold price as they've been doing for so many years now.
I have one more question about China, but since we were talking about the gold stocks around the world, and a lot of the people listening to the show probably aren't aware of this, but James, you were the original guy who took the original GLD prospectus filing back in 2004 and shredded it. Basically showed how, in a sense, GLD was in a legal structure sense is not what it was marketed to be. And that is, it's got a whole legal network or whole legal framework in which it can actually lease gold out the side door. There's no accountability in terms of what the GLD trustee reports versus the amount of gold that's actually being held in the vault. And since the end of 2012, the amount of gold that is actually being reported to be in the vaults is down almost 50%. Now, the market explanation for that, or the standard Wall Street propaganda for that, is, well, yeah, the price of gold is down. but the amount of gold that's actually contained in the vault is not contingent on retail investor demand for the shares. It hinges on whether or not one of the approved participants collects a basket of shares and exchanges it for for gold that it can remove out of the vault in exchange for those shares. Currently, GLD, I think, is reporting around 730 tons in the vault. And I'm just curious, do you think that a lot of that gold that had been stored in GLD or reported to have been stored in GLD is now sitting in vaults in China?
Yeah, I do. The GLD prospectus is quite clear. It doesn't really say that the shares are backed by gold. It says that the whole GLD structure was prepared in order to track the price of gold, and that there are different ways that the fund can be managed in order to track the price of gold, including owning some physical metal. But there are also other ways in which you can use things it can use to track the price of gold. There's so many loopholes in that prospectus, and as the saying goes, they're big enough you can drive a Mack truck through them, that one has to take a prudent point of view and just assume that because the prospectus itself says it's there to track the price of gold, it's only the media that tells you that the GLD is there to be backed by gold. The prospectus doesn't do it. It's the media that does it, and it's led to this huge misconception as what the GLD is. It's a trading vehicle in paper gold. It's not an alternative to owning physical metal. That's the key. So has a lot of that metal gone to Asia? I would say yes, it probably has, because it was advantageous to the 6 parties, the authorized participants that control and manage GLD, to do that. It was, they look after their own interests. They're not looking after the interests of the shareholders of GLD.
How reliable do you think that 734 ton number is that they're reporting? I mean, do you think there's actually 734 tons of gold sitting in HSBC's vault plus the sub-custodian vaults? Or even if it's physically sitting there, to what degree do you think it might have legal paper title claims attached to it?
Well, I think the 734 number is accurate. It does get audited, but you have to ask yourself, well, what is it that they're auditing? If you look at the 10K or the 10Q, it doesn't say gold. It says gold and gold investments. So, there's 734 tons of gold and gold investments that are audited. The problem is we don't know how much is physical metal, if any, sitting in the vault, and how much is gold investments. Gold investments could be an IOU that the fund is basically saying is as good as gold, but they're using it in order to help them manage the fund so that it tracks the gold price. So, yeah, I think the 734 is an accurate number, but, unfortunately, Dave, there's just no way of knowing what portion of that, if any, is physical and what portion of that is paper. So I just basically ignore GLD. And I say to people, look, if you want, I explain the difference between physical on one hand and paper on the other. Physical is a tangible asset. Paper gold is a financial asset that has counterparty risk. Now, are you buying gold because of its safe haven status, or are you buying gold because you want to try profiting from fluctuations in the gold price, either up or down? If you're doing the former, then you need to own physical metal, because only physical metal does not have counterparty risk. On the other hand, if you want to try profiting by trading, and I only recommend this for professional traders, not for the average guy on the street, then you can look at things like futures, options, various derivatives, and the GLD itself as a trading vehicle. But it's not an alternative to owning physical metal, and you should definitely not view it to be an alternative to owning physical metal.
Yes, and actually, just to point out for listeners, GLD, like James said, it's not an investment in physical gold. It's a derivative investment in gold. And also, just to clarify, when the term audit the gold is used here, according to the prospectus, it's not the actual physical bars that get counted up and verified as to their authenticity. The auditor does not look at the physical bars. It examines the records that are provided to it by the custodian and the trustee.
Exactly right. That's why on the 10Ks and the 10Qs that they report to the SEC, the GLD shows on its balance sheet as its asset gold and gold investments. If the auditors actually went into the vault and counted the bars, instead of having one line item, they would have two. They would have gold, and then the second one would be gold investments. But the GLD doesn't do that because gold physical is different than gold investments, which is paper.
Yes, and also they do reference, I don't know if they still do on the website, because like you, I largely ignore GLD now, but I think they reference an outfit that does a physical audit of the bars, but that audit is nothing but just a sampling of the gold that's in HSBC's vaults. No one's allowed to go into look at the gold that's being held by the sub-custodians, and that's explicit in the prospectus.
Yeah, that's true. I heard something else recently. For years and years and years, if you had an account with the Bank of England, even if you were a central bank, you weren't permitted to go in and actually audit and look at your gold to prove that it was really there and it was allocated and not being loaned out or hypothecated or double counted, et cetera. I understand that the Bank of England has recently changed that rule that you can go in and audit. So it's particularly surprising that the GLD doesn't do it. But again, the GLD is there for another purpose, to trade paper rather than be backed by physical metal.
The Bank of England may do that, but we know the Fed doesn't, because we know that Germany wanted to come over and look at their gold being held in the vaults here, which apparently is being held in 9 Fed vaults, and they were only permitted to go into one vault to look at it.
Yeah, it really makes you raise your eyebrows to what's really going on. There's so much, the whole gold market is so opaque. It's all the more reason, to own physical and totally ignore, the paper side of the market.
So I want to just circle back here to the China issue, and it might be a good way to kind of wind this down. I mean, it's been well publicized that not just China, but especially the People's Bank of China, the Chinese central bank, has been accumulating an enormous amount of physical gold that they do demand delivery of. And no one knows, other than the Chinese central bank, how much gold the Chinese central bank has. There's been a number of studies done on it, and the range of estimates is very wide. Probably one of the most credible studies has been done is the one that was done by your colleague, James Alistair McLeod. And I think it's been a while since I looked at it, but I think he examines the issue and says that according to what he can find, the People's Bank of China has been accumulating gold since the early 90s, and I think the number he comes up with is somewhere north of 20,000 tons. Does that sound right?
Yeah, that's for China in an aggregate. Includes the People's Bank as well as the more recent additions, which the Chinese authorities have allowed the private market to accumulate.
So I'm wondering, in the context that we know the central bank is likely adding an enormous amount of gold to its just call it its foreign reserve base. Do you think that at some point China is going to reintroduce gold into the global monetary system?
I have my doubts. A lot of people see this happening, but I question. Well, why? If you're going to introduce gold into the global monetary system, you have to be in favor of limited government and free markets. And maybe the Chinese authorities are moving in favor of free markets and property rights. Although I still have some questions about the way they handle property rights. But I'm not so sure they're in favor of limited government because pretty much the government rules supreme in China and has decisions that favor the government over property rights, as I understand it. So I'm not so sure you're going to see a Chinese yuan backed by gold. But I do know one thing. whoever owns the gold is in a much better position than the person who doesn't own the gold. And I think that's something China clearly understands. And the other thing is that, I spent most of the 1970s, living in Asia. I didn't travel to China at that time because it just nothing was going on. I mean, this is just a few years after the Cultural Revolution had taken place, and it was totally backward and, totally dominated by Mao Zedong. And free markets and market economy were the last thing that, people were thinking about at that moment in time. But I did do a lot of business when I was in Asia with overseas Chinese businessmen, people who had fled before the communist takeover and had set up homes, businesses in different countries around Southeast Asia and East Asia. And one of the things I learned from that experience is that, the Chinese see gold differently than people in the West see gold, because of cultural, traditional, historical factors. It's intuitive to the typical Chinese person that gold is money. There's a level of intuition and recognition that you see in Asia that gold is money that you don't just see, in the West. So, maybe at the end of the day, maybe I'll be pleasantly surprised and we're going to see gold circulating as currency in some form in Asia with the Chinese government's blessing. But, only time will tell. But regardless whether gold is circulating as currency, again, at some point in time in the future, you want to own gold because it's money. It preserves purchasing power over long periods of time. And it's a form of liquidity. It's a form of, money, liquidity, that's not contingent upon anyone else's promise. It doesn't have counterparty risk when you own that physical metal. And that in itself, in this uncertain financial environment, is enough reason to be accumulating physical metal, particularly at these relatively low prices.
I guess kind of the way I've been thinking about it, I just wanted to bounce this off you, is not so much in terms of China rolling out a gold-backed yuan and saying this is the new reserve currency, but essentially floating a gold-backed yuan. And in the context of China now being the world's largest importer and exporter, saying to the rest of the world, you're free to trade with us, but you either have to convert your currency into ours in order to settle the trade, or you have to demonstrate that your currency is backed by gold the way ours is. And to me, that's the way that they would capitalize on the sheer power that you referenced that large holders of gold have.
Yeah, you put it much more eloquently than me, because you've actually brought it down to the practical situation. And there's, like I said, if you own the gold, you're in a better position than if you don't own the gold. And you're taking it down to the trade level. And I think that's very, very important. Because why should, they take the IOUs of countries that cannot fulfill on that promise? Because, at the end of the day, goods and services are paid for with goods and services. If you give somebody an IOU in exchange for a good that you receive, the person who's giving you that good isn't really being paid. He's not paid until he takes that IOU and converts it into some good or service that he needs or he wants. And we've got this huge accumulation of IOUs around the world expressed in terms of global reserves. And a lot of those global reserves, the IOUs, they're going to be defaulted upon. So yeah, the way you've described it, a Chinese yuan, not formally backed by gold, not linked to gold, maybe not redeemable into gold, but the gold is there. That could end up being a Chinese approach to developing a new international monetary system. They are working in that direction. They've created, they're in the process of creating, I believe, with the Soviet Union, with Russia, if not doing it independently, their own SWIFT payment network, so that they're not relying on the SWIFT system used in North America and in Europe. They don't want to be reliant on clearing and settling transactions through the Federal Reserve. Or the ECB. They want to be reliant on clearing and settling transactions through the banks in China, and they've made great strides in that regard. If you look at what's happened over the last 5 years or so, the use of the Chinese yuan in terms of international trade transactions because of reciprocal agreements that China has created with a lot of different countries around the world, has risen dramatically, to the detriment of the dollar, which had previously been used for clearing and settling these international transactions. So we definitely live at interesting times. Things are changing all of the time. But the key thing that we're focusing on here, Dave, is that the international monetary system that's been in place, basically since President Nixon no longer, or told Treasury Secretary Connolly to, quote, suspend temporarily, unquote, the dollar's conversion into gold. The monetary system that we've used since then the international monetary system is changing dramatically. And that also has impact for the domestic U.S. economy as well.
Thank you very much, Mr. Turk. That is greatly appreciated. Seriously.
Well, thanks, Rory. It's been a pleasure talking to both of you. And I hope you've found this information useful and helpful. And let's do it again in the future sometime.
Let's definitely do it. This has been an incredible session, and you've been really generous with your time, and we would love to have you back on at some point in the near future.
Okay, it's a date. Thanks, guys.
All right. Well, thanks you very
James.
much.
Okay, bye-bye.
Bye.